Hello everyone, and welcome to Kaleidoscope Channel. On May 7th, the State Council Information Office held a highly anticipated press conference themed Financial Policies to Stabilize the Market and Expectations. The event was attended by Pan Gongsheng, Governor of the People's Bank of China, Li Yunze, Director of the National Financial Regulatory Administration, and Wu Qing, Chairman of the China Securities Regulatory Commission. Its format was nearly identical to the press conference held on September 24 last year. Once again, Pan Gongsheng played the central role, unveiling a comprehensive monetary policy package aimed at tackling mounting domestic and international pressures. But a pressing question remains: can these measures truly rescue China's economy, especially when the banking sector, including the four largest state-owned banks, is mired in a debt quagmire? Pan acknowledged the increasing uncertainty of the global environment since April, citing economic fragmentation and intensifying trade tensions disrupting global supply chains. Still, he maintained that China's domestic financial system remained robust. He pointed to a quick rebound of the Shanghai Composite Index after a brief dip on April 7, a steady 10-year Treasury yield around 1.65%, and the yuan's exchange rate returning to roughly 7.2 after a slight depreciation. These indicators seem optimistic on the surface, yet they obscure deeper crises. Pan then introduced 10 monetary policy measures across three major categories, including a 0.5 percentage point cut in the reserve requirement ratio, the release of 1 trillion yuan in long-term liquidity, a 0.1 percentage point cut in the policy interest rate, and a 0.25 percentage point reduction in Housing Provident Fund loan rates. These policies cover liquidity supply, interest rate adjustments, and structural tools, undeniably significant in scale. From May 8, some measures have already come into effect, such as the 7-day reverse repo rate dropping from 1.5% to 1.4%. Meanwhile, Li Yunze revealed that large commercial banks were accelerating capital replenishment, while small and medium-sized institutions were seeking capital through multiple channels. In the first 4 months of the year, banks and insurers provided 17 trillion yuan in new financing to the real economy, a sizable figure. Regulators also reduced the risk weight for equity investments by insurance firms to stimulate capital markets and offered targeted support to businesses impacted by tariffs. Still, while comprehensive, these measures fall short of addressing the root problems. Why? Because China's economic malaise cannot be resolved through monetary policy alone. Pan's current package echoes the direction of policies announced on September 24 last year, which briefly sparked a stock market rally that fizzled within a week. Despite successive rate and reserve cuts in 2023, the downturn remained largely unaltered. Why? Let's examine several core issues. First, the bursting of the property bubble. Real estate was once the backbone of China's economy, contributing nearly 30% of GDP. But in recent years, the sector has contracted sharply, housing prices have dropped, developers face cash shortages, and buyer confidence has collapsed. This has turned many mortgages into non-performing assets, hitting banks' balance sheets hard. The four major state-owned banks, ICBC, Agricultural Bank of China, and China Construction Bank, issued massive loans during the real estate boom, many of which are now irrecoverable. Official data shows that by Q1 2025, the 6 major state-owned banks held 1.57 trillion yuan in non-performing loans. ICBC had 395 billion, CCB 358 billion, ABC 335 billion, and BOC 281 billion yuan in bad loans. In just Q1 2025, ICBC's bad loans grew by 15.9 billion yuan and CCB's by 13.5 billion. And this may be just the tip of the iceberg, as many bad debts could be hidden in opaque financial reports. The real estate collapse has also triggered a balance sheet recession. Corporate and household assets have shrunk, leading to reduced consumption and investment. People are more inclined to save than spend or invest, increasing the burden on banks. Banks earn profit from the spread between deposit and loan rates, but with weak demand for loans and rising deposit costs, margins are thinning. In Q4 2024, the net interest margin for commercial banks was just 1.5%, down 17 basis points year-over-year, historic low. Every day under such conditions, banks are bleeding financially. Second, the local government debt crisis. According to the IMF, local government debt in China exceeded 60 trillion yuan in 2023, about 17% of total banking assets. Many local governments can no longer pay even the interest on their debts. Over 85% of local economic spending depends on government investment. When fiscal resources dry up, local economies stall. This leads to business closures, rising unemployment, and a consumption slump, creating a vicious cycle. The central government has tried to alleviate this with transfer payments, but the Ministry of Finance itself is under stress, relying on large-scale bond issuance to stay afloat. In 2024, monthly government bond issuance exceeded 1 trillion yuan, highlighting financial strain. Finance Minister Lan Fowen proposed solutions to local debt, but the central government made it clear it would not contribute a single yuan, worsening the situation. Third, deflation. One of the greatest current threats is deflation, manifested in weak consumer demand and production overcapacity. With people unwilling to spend, companies produce more only to incur losses, reducing economic vitality. Deflation also worsens banks' troubles by suppressing credit demand and profitability. Fourth, the external shock from the U.S.-China trade war. U.S. tariffs averaging 245% on Chinese goods have severely impacted export-driven industries like electronics, machinery, and textiles. Exporters in coastal provinces such as Guangdong and Zhejiang are struggling with falling orders and cash flow issues, leading to higher loan defaults. S&P Global estimates that by 2027, non-performing loan ratios for SME loans could rise to 9.3% to 9.6%. A mere 1 percentage point rise in default rates on export-related loans could mean 100 billion yuan in credit losses, over 60% of which would be borne by the 6 major state-owned banks. Together, these issues have triggered a subprime crisis in China's banking sector. The Big Four banks alone hold a staggering $11 trillion, roughly 78 trillion yuan, in total debt. In Q1 2025, the 6 major state banks reported revenues of 910.2 billion yuan, a year-over-year drop of 13.9 billion, and net profits of 344.4 billion, down 7.3 billion. Though ICBC and CCB still posted profits above 80 billion yuan, their declines approached 4%. Rising bad loans and declining profitability are pushing these banks toward a precarious financial state. At the start of 2024, the Ministry of Finance injected 500 billion yuan into the Big Four banks to stabilize their capital. Bank of China received 165 billion, Postal Savings Bank, CCB, and Bank of Communications each received over 100 billion. Yet critics argue that this cash infusion merely delays the inevitable and cannot resolve structural problems. Weak profitability, massive bad debts, overextended credit, and external trade risks continue to erode banks' foundations. Worse yet, small and medium-sized banks are even more vulnerable. As of early 2024, 199 mid-sized banks had been dissolved, merged, or shut down, including 36 credit cooperatives, 56 rural commercial banks, and 100 village banks. These banks were heavily dependent on local governments and real estate projects, both of which have collapsed. Economist Li Hongqing warns that China's banking system is on the brink of a large-scale debt crisis. Without decisive action, bank failures could trigger a domino effect that threatens the entire financial system. In contrast, the impact of COVID-19, though severe, was short-term and could be contained through vaccines and lockdowns. But this subprime crisis is systemic and long-term. Real estate collapse, local debt, deflation, and trade war risks are entangled into a far more formidable challenge than the pandemic. Pan's strong monetary policy might be a shot of adrenaline for a critically ill patient, but it doesn't cure the disease. A true solution requires bold fiscal policy, such as direct central intervention in local debt restructuring or large-scale stimulus programs to boost consumption. But with the central government itself stretched thin and bond issuance already nearing the limit, and with Finance Minister Lan Foan notably absent, confidence in policy resolve is waning. At a deeper level, China's financial system suffers from structural flaws. Economist Wang Guangmei notes that the banking system is overly bureaucratic, with interest rates centrally set and banks earning fixed margins under government protection. This model works in boom times but lacks the adaptability for downturns. Banks previously profited from mortgages, wealth management products, and SME loans, but those sources have dried up. Property loans have gone bad, wealth products frequently default, and SMEs can't afford new borrowing due to the economic slump. The traditional banking model has collapsed, and new engines of growth have yet to emerge. For ordinary people, the impact is already palpable. Households prefer saving over spending, weakening economic dynamism. Business closures, rising unemployment, and falling incomes are putting families under crushing debt. The bank's crisis affects not just the financial system but could drag down the entire economy. If the banking system collapses, it could spark deposit runs, freeze credit, and even incite social unrest. So, what lies ahead? Some experts believe that unless the government takes drastic measures, such as printing money or large-scale debt restructuring, the banking crisis could erupt fully in the coming years. The Carnegie Endowment for International Peace reports that by the end of 2024, China's non-financial sector debt reached 303% of GDP, far above the global average of 238%. High debt levels combined with economic decline are rapidly accelerating default risks. In conclusion, China's subprime banking crisis under the shadow of U.S. tariffs is even more severe than the pandemic, not just economically, but in terms of social stability. With the Big Four banks shouldering $11 trillion in debt and widespread failures among small banks, the deep-rooted issues continue to surface. What lies ahead remains uncertain. So, what do you think could help China escape this crisis? A bold fiscal plan? Deep reforms? Or something else? Feel free to share your thoughts in the comments. This is Kaleidoscope. Don't forget to like and subscribe. Your support means a lot to us. Thank you, and see you next time.